10:03 m. EST, COMEX trading floor. The bid-ask spread just exploded to $3.50 per ounce, triple the normal width in under 10 minutes. Refresh your screen. COMEX silver futures showing orderly two-sided flow climbing steadily. Now switch to dealer sites. Physical premiums hitting 25% above futures with inventory counters dropping in real time. Pull up the arbitrage window. Paper trading at $22.15. Physical dealers quoting 29 ZERs for immediate delivery. That's a $6.85 gap where there should be pennies. This isn't a pricing inefficiency waiting for smart money to arbitrage away. This is the market screaming that paper and physical have decoupled, that the mechanism connecting them has failed, that the system promising interchangeability between contracts and metal is breaking down under observable stress. This move is about more than volatility. It's signaling a breakdown that could force every paper holder into a settlement they never agreed to. By 10:20 Eastern, the price explosion had become impossible to ignore. COMEX silver futures spiked 2.0 per ounce in 5 minutes. A vertical move that triggered circuit breakers on 6 algorithmic trading systems. Volume surged to 140% of the daily average before noon. The order flow showed massive institutional buying, the kind of positioning that suggests funds are scrambling to cover short exposure or secure long positions ahead of a perceived supply crisis. On screen, it looked like a classic momentum rally, clean price action, tight spreads, orderly execution. Switch tabs to the physical dealer sites. Out-of-stock banners appearing across every major U.S. retailer. Serial numbered bars that were available an hour ago now showed notify when available buttons. Wholesale platforms listed allocation by request only. Code for we have metal, but we're rationing it. The physical market wasn't celebrating the rally. It was experiencing a supply shock in real time, with inventory evaporating faster than dealers could update their websites. This is where the divergence becomes systemic. Paper traders see a bullish technical breakout and pile in. Physical buyers see scarcity and panic. The futures market operates on leverage and speculation. You can buy and sell contracts without ever touching metal. The physical market operates on possession and delivery. Every transaction requires actual ounces to change hands. When paper surges and physical depletes simultaneously, it means one market is disconnected from reality. Guess which one? Physical supply is evaporating while paper traders celebrate the rally, unaware that the metal backing their contracts might not exist in deliverable form when settlement comes. 10:45 Eastern, and the cross-market divergence had reached historic proportions. COMEX futures trading at $22.50, Shanghai physical market quoting spot prices at $26.60. That's 18% backwardation, near-term physical commanding a massive premium over Western paper contracts. In a functioning market, that gap closes within minutes as arbitrageurs buy cheap paper, stand for delivery, and sell expensive physical. The arbitrage profit is guaranteed, the mechanism is simple, and capital floods in to exploit it. Except this time, the arbitrage wasn't executing. The gap kept widening. Why? Because arbitrage requires one critical ingredient: the ability to actually take delivery of physical metal from the paper market and transport it to the physical market. If the exchange can't deliver metal, or if logistical constraints prevent movement between venues, the arbitrage breaks down. The price gap becomes a measure of system dysfunction rather than opportunity. By late morning, that dysfunction was quantifiable. Nearly 20% separation between what futures contracts promised and what physical metal cost in Asia. This discrepancy between physical delivery needs and paper pricing isn't academic. It's existential for anyone holding paper exposure expecting to convert it to metal. If you own futures contracts or ETF shares, you're betting the system can deliver physical metal at the contracted price. If the system can't deliver, you'll receive cash settlement at a paper price while physical metal trades at a substantial premium. That gap represents your loss imposed by mechanical failure, not by market movement. This is a real supply and demand crisis unfolding across time zones and asset classes. It can't be ignored, and it can't be wished away by assuming markets always self-correct. By 11:00 Eastern, dealer sites were documenting a collapse in available inventory. Premiums had spiked 25% on physical bars overnight, and now those bars weren't available at any premium. Refresh the major retailers: 0 inventory on American Silver Eagles, 0 on Canadian Maples, 0 on generic rounds. The wholesale platforms showed similar depletion. One major dealer's site displayed a message: due to unprecedented demand, new orders are being processed on a first-come, first-served basis with extended delivery times. Translation: we're out of stock and don't know when we'll get more. The COMEX screen still showed active trading, tight spreads, normal market function. The futures curve remained orderly, with deferred contracts trading at slight premiums to near term, a normal contango structure suggesting adequate supply for future delivery. But click through to the dealer sites showing actual metal for immediate sale, and the picture inverted. The physical market was pricing extreme scarcity, while the paper market priced business as usual. That spread, between derivatives confidence and physical panic was now quantifiable at over $7 per ounce. This gap that shouldn't exist carries a specific warning. The paper market hasn't priced in the supply reality the physical market already knows. When dealers run out of inventory, when premiums spike to levels that make retail buying uneconomic, when wholesale allocations get rationed, that's proof of insufficient supply meeting surging demand. The futures market, trading millions of ounces daily, operates on the assumption that physical metal exists in sufficient quantity to settle contracts if needed. The physical market, running out of inventory before lunch, is screaming that assumption is false. The spread is now a clear indication that the system is under extreme stress, and one of these markets is badly mispricing reality. 11:20 Eastern, and the arbitrage failure had become the story within the story. Every finance textbook explains how arbitrage keeps markets efficient. When the same asset trades at different prices in different venues, traders buy low and sell high until prices converge. It's supposed to be automatic, mechanical, guaranteed profit, except it requires the asset to actually move between venues. For silver, that means taking delivery from COMEX, transporting metal to physical markets showing premiums, and selling at the higher price. That arbitrage should have started flooding the system with delivery requests hours ago. It didn't. The COMEX price continued trading $5 an hour below where physical silver sold in dealer markets. That gap represents pure profit for anyone who can bridge it. But the gap kept widening instead of closing. Why? Two possibilities. Either the metal available for delivery at COMEX is insufficient to satisfy arbitrage demand, or the logistical infrastructure to move metal between markets is overwhelmed. Either scenario confirms the same underlying crisis. The paper market has sold obligations it cannot physically fulfill, and the arbitrage mechanism that's supposed to prevent this scenario has collapsed. Watch what this means for market structure. Arbitrage isn't just about profit, it's the mechanism that enforces price discipline between related markets. When arbitrage fails, markets can diverge indefinitely, limited only by the willingness of participants to believe contracts will eventually settle at fair value. In the physical silver market, that belief is evaporating. Buyers are paying massive premiums because they don't trust paper markets to deliver metal at contracted prices. Sellers are withholding inventory because they anticipate even higher prices as the supply-demand imbalance intensifies. The failure of arbitrage is a sign of deep systemic malfunction, proof that the infrastructure connecting paper promises to physical reality has broken under stress. 11:40 Eastern and dealer inventory had reached a crisis threshold. Pull up the largest U.S. bullion retailers and check their product pages. Zero available inventory on every single silver product line. Not delayed, not backorder, but complete unavailability. One site's banner read, "We are temporarily unable to accept new silver orders due to supply constraints." Another displayed inventory counters that had ticked down to zero and stayed there. The wholesale platforms used by institutions showed similar depletion, with allocation queues extending into weeks. This is what a liquidity vacuum looks like in physical commodity markets. Liquidity doesn't just mean bid-ask spreads, it means actual availability of the asset for immediate transaction. In paper markets, liquidity is infinite as long as someone is willing to take the other side of your trade. In physical markets, liquidity is constrained by how much metal actually exists in accessible form. When every dealer simultaneously runs out of inventory, when supply chains can't replenish stock fast enough to meet demand, when buyers with cash in hand can't acquire metal at any premium, that's proof of a fundamental supply-demand imbalance that cannot resolve quickly. The market status was unprecedented, major dealers posting out-of-stock warnings on products they normally stocked in volume, premiums spiking to levels that should have incentivized massive supply response, yet inventory continued depleting rather than replenishing. This suggests either that producers and wholesalers were holding back supply anticipating higher prices, or that production and logistics couldn't scale to meet surge demand. Either way, retail and institutional buyers faced the same reality. Paper exposure was easy to acquire through futures or ETFs, but physical metal was becoming unavailable regardless of willingness to pay. Dealers are running dry, and the gap between paper availability and physical scarcity is getting larger with every passing hour. By noon, Eastern, the divergence between COMEX and physical markets had grown to proportions that demanded explanation beyond normal volatility. COMEX silver futures settled the morning session near $22.9 per ounce. Orderly trading, normal spreads, institutional flow suggesting professional participants viewed this as a technical rally within historical ranges. Switch to physical markets. Dealers quoting spot prices above $27 for immediate delivery where inventory existed at all, premiums ranging from 20% to 30% depending on product form and delivery timeline. That's a $5 plus gap between what paper contracts trade for and what physical ounces cost. In gold, such divergences occasionally appear during extreme crisis but typically measure in single-digit percentage points. In silver, a 22% plus premium of physical over paper represents a historic dislocation seen only during severe supply disruptions or exchange intervention. The 2011 silver spike saw similar divergences. The March 2020 COVID crisis produced brief premiums as logistics froze. But both those episodes lasted days before normalizing. This divergence was widening, not narrowing, as the trading day progressed. The mechanism behind this split is straightforward. COMEX trades contracts that promise future delivery of silver at agreed prices. Most contracts settle in cash without physical delivery. Traders close positions for profit or loss without ever touching metal. That system works beautifully for speculation and hedging. It breaks when a significant percentage of contract holders demand actual delivery because the exchange doesn't hold enough physical inventory to satisfy all outstanding obligations. The warehouse stocks backing COMEX silver had been declining for months before this event, raising questions about deliverable supply. Now, with physical markets showing acute scarcity and paper markets pricing calm, the divergence reveals the fractional nature of the paper system. This divergence isn't just a pricing issue, it's a global market stress test, showing which markets reflect reality and which reflect leverage-driven fiction. 12:15 Eastern, and the Asian session data was confirming what the divergence had suggested. Tokyo physical dealers reporting sold-out inventory on investment-grade bars. Hong Kong premiums climbing past 30% over COMEX spot. Shanghai Gold Exchange showing silver spot trades at levels that implied massive buying pressure from mainland Chinese institutions and retail investors. The flow was unidirectional. Asian buyers were accumulating physical metal at prices that suggested they didn't trust Western paper markets to deliver at contracted values, or they anticipated much higher prices ahead that justified current premiums. Cross-market dynamics were intensifying the pressure. When Asian physical markets trade at substantial premiums to Western paper, it should trigger metal flows from west to east, export silver from lower-priced regions to higher-priced regions until prices equalize. That arbitrage requires physical transportation, customs clearance, and delivery logistics that can take weeks. In the interim, prices should converge as traders anticipate the coming supply increase in Asia and supply decrease in the West. Instead, the premium was widening, suggesting either that physical flows weren't sufficient to meet demand, or that market participants doubted such flows would materialize at all. The data emerging from dealer sites, exchange reports, and physical market quotes painted a unified picture. Western paper markets were underpricing risk, Asian physical markets were overbidding for security, and the mechanism to bring them into balance wasn't functioning. For retail investors and institutions holding silver exposure through ETFs, futures, or unallocated accounts, this divergence carried a specific warning. When settlement comes, you'll receive value determined by paper markets, not physical markets. If paper trades $5 below physical, your position settles at the lower price, while metal holders retain assets worth the higher physical value. That gap represents wealth transfer from paper to physical, from those who trusted the system to deliver to those who demanded possession before the system broke. 12:30 p.m. Eastern, and market structure was shifting in ways that trapped paper holders in losing positions. The futures curve had inverted, near-month contracts now trading above deferred contracts in backwardation that signals immediate scarcity valued more highly than future supply. Normally, futures curves slope upward to reflect storage costs and interest rates. When they invert, it means the market desperately needs metal now and can't wait for future delivery. That desperation gets priced into premiums that make near-term settlement far more expensive than anticipated. For institutional shorts who sold futures contracts expecting to profit from stable or declining prices, backwardation creates a nightmare scenario. To exit their positions, they must either buy back contracts at elevated prices or deliver physical metal to fulfill obligations. But delivering requires acquiring metal in a physical market that's trading 5 nor plus above the futures price they're contractually obligated to deliver at. Every ounce delivered represents a direct loss equal to the spread. Cash settlement offers escape, but exchange rules may force physical delivery if counterparties demand it. Either way, shorts are trapped between mounting losses and forced closure at prices that reflect the system's inability to deliver what it promised. The settlement mechanics are crucial here. COMEX allows contract holders approaching expiration to either roll positions forward to future months or stand for physical delivery. Most roll to avoid the logistics of taking possession, but in a supply crisis, those standing for delivery gain leverage. They can demand actual metal, forcing shorts to acquire it at physical market prices regardless of what futures trade at. The exchange can impose cash settlement to prevent this squeeze from spiraling, but doing so confirms the system cannot deliver its obligations and forces paper holders to accept cash at paper prices, while physical holders retain assets worth physical premiums. If you hold paper, you might be in for a surprise at settlement time, a settlement that favors those who can deliver over those who need to receive. 1 p.m. Eastern, and gamma pressure was compounding the delivery squeeze. Options expiration was approaching with massive open interest at strike prices above current futures levels. Dealers who sold those call options and hedged with short futures positions now faced explosive risk. If silver spiked above key strikes, their hedging would fail and losses would accelerate. To protect against that scenario, dealers would need to buy futures to cover short hedges, adding buying pressure precisely when the market was already stretched. This is gamma squeeze mechanics. When hedging activity itself becomes a destabilizing force that drives prices higher, triggering more hedging, creating a feedback loop. The math is ruthless. Large options positions at strikes of $25, $28, and $30 meant dealers potentially held significant short futures hedges. If silver rallied through those strikes, dealers would face billions in exposure and would be forced to cover regardless of market conditions. That forced buying would push futures higher, widening the gap with physical markets further, potentially triggering more delivery requests from longs seeking to exploit the spread. The system was trapped in a mechanical feedback loop where each component, options, futures, physical delivery, reinforced stress in the others. For institutional participants, the message was clear. There's nowhere to hide. If you're short futures, you face delivery pressure or cash settlement at rising prices. If you sold call options, you face potential losses that accelerate as prices spike. If you're long paper expecting to convert to physical, you face potential cash settlement at paper prices below physical reality. The only safe position is physical metal in allocated storage, outside the paper system, immune to settlement risk and delivery failure. Banks and shorts will be forced to cover, and soon, the gamma pressure alone could trigger a cascade that makes current premiums look modest. The squeeze isn't theoretical speculation. It's mathematical certainty once the feedback loop engages. 1:30 p.m. Eastern, and geopolitical factors were feeding into supply constraints that intensified the squeeze. Reports emerged of mining operations in key producing regions facing production disruptions due to political instability. Major silver-producing nations, Mexico, Peru, China, were experiencing regulatory pressures, environmental restrictions, or labor disputes that threatened output. When supply chains are already stretched and demand is surging, even marginal production disruptions can have outsized impact on available inventory. Add to that the sovereign accumulation trend. Central banks and government entities in Asia and the Middle East had been quietly increasing precious metals reserves as hedges against currency instability and geopolitical risk. That demand was strategic, not speculative. Buyers who acquire and hold indefinitely, removing metal from circulating supply. When governments compete for the same supply pool as retail and institutional investors, scarcity intensifies and premiums widen. The metal flowing into sovereign vaults doesn't return to the market, making each additional ounce of demand harder to satisfy. The confluence was explosive: declining production, rising sovereign demand, surging retail and institutional buying, and depleted dealer inventories. Each factor alone might cause modest premiums. Combined, they created conditions for a supply crisis that couldn't resolve quickly. New mine production takes years to bring online. Sovereign demand won't reverse based on price. Retail panic buying feeds on itself. The only variable is institutional positioning, whether paper market shorts would capitulate and cover before being forced to deliver physical they don't have. For viewers trying to assess risk, the implications were stark. Geopolitics is now feeding into the silver squeeze, adding layers of uncertainty that make supply restoration unlikely in the near term. Production isn't scaling to meet demand. Sovereign buyers are removing supply permanently. Retail inventories are depleted. And the paper market, which promised liquidity and interchangeability with physical, was revealing itself as a fractional system built on assumptions that don't hold during crisis. Supply is only going to get tighter from here. That's not speculation. It's the inevitable math of constrained production meeting accelerating demand. 2 p.m. Eastern, and endgame pricing dynamics were becoming clear. The spread between COMEX paper and physical dealer markets had widened to 5.7 per ounce and was holding there despite every incentive for arbitrage to close it. Dealers who still quoted prices were refusing new orders above certain volumes, implementing purchase limits, or requiring extended delivery timelines that suggested supply constraints weren't temporary disruptions, but structural shortages. Physical premiums were at all-time highs for this market cycle, exceeding levels seen during previous squeezes, yet inventory wasn't replenishing. This persistence of extreme premiums signals that market participants expect the squeeze to intensify rather than resolve. If dealers thought supply would normalize soon, they'd accept orders at current premiums knowing they could fulfill them profitably. Instead, they're limiting exposure, which suggests they either lack confidence in supply restoration or anticipate even higher premiums ahead. Either interpretation confirms the same underlying reality. The supply-demand imbalance isn't temporary volatility, it's structural dysfunction that will force price adjustment. The mechanism is straightforward. Physical buyers are willing to pay 27 PLARs per ounce because they value possession over paper claims. Paper holders are trading contracts at $22 because they assume settlement will occur at reasonable prices. But settlement must eventually resolve to physical reality, either through actual delivery or cash settlement at adjusted prices. If the exchange cannot deliver metal in sufficient quantity, it must either allow prices to spike until demand destruction occurs, or impose cash settlement that transfers value from paper longs to those holding physical. Both outcomes favor physical holders over paper holders. The system has to adjust, and adjustment means prices must rise until either supply increases or demand decreases enough to rebalance the market. With production constrained, sovereign demand persistent, and retail inventories depleted, the adjustment mechanism is price. How high? High enough to either incentivize massive new supply or destroy enough demand to bring the market into balance. Given the structural constraints on supply and the strategic nature of much current demand, expect prices to skyrocket beyond current premiums. This isn't volatility, it's repricing of fundamental value. 2:30 Eastern, approaching the market close, and the viewer consequence was becoming undeniable. Retail investors attempting to buy physical silver were locked out, unable to acquire metal at any reasonable premium, facing extended delivery timelines, or being told inventory was unavailable. Those holding paper exposure through ETFs or futures were watching a price that didn't reflect what physical metal actually cost. The two-tier market had crystallized. Those who already held physical were sitting on assets appreciating in real terms, while those holding paper were exposed to settlement risk that could force them out of positions at prices disconnected from physical reality. The practical implication: if you're not prepared for the price explosion, you could lose everything. Not through market decline, but through mechanical failure of the system you trusted to convert paper to physical. ETF shares might settle in cash, futures contracts might force cash settlement, unallocated accounts might deliver at paper prices while physical trades far higher. The gap between what you think you own and what you can actually claim was widening by the hour, and retail investors, coming late to the trade, buying into strength, assuming liquidity would always be available, were discovering they had entered a market that no longer functioned according to normal rules. The premiums told the story. Physical buyers paying 25% plus over spot weren't irrational. They were pricing in settlement risk, delivery failure, and the possibility that paper markets would simply stop honoring conversion requests at contracted prices. Those premiums were insurance against a system that had oversold its physical backing and might not be able to deliver when demand surged. Paper holders who dismissed those premiums as temporary volatility were betting the system would self-correct, that arbitrage would eventually close the gap, that exchanges would fulfill their obligations. But every hour the gap stayed wide was another hour of proof that the system couldn't deliver what it had promised. If you're holding paper exposure expecting to convert to physical, you're holding a claim on metal that may not exist, and discovering that reality at settlement might be the most expensive lesson you ever learn. 3:30 p.m. Eastern, final market close, and the closing numbers confirmed what the day's action had foreshadowed. COMEX silver futures settled at $22.35, up modestly from the morning but well below intraday highs. Physical dealer sites, those still displaying prices, showed quotes starting at $28.50 for products with extended delivery timelines. The spread had widened to $6.15 per ounce, over 27% premium of physical to paper, the largest closing gap in over a decade. That spread wasn't closing because the mechanism to close it, arbitrage through delivery, had broken completely. Inventory status remained at zero across retail platforms. Wholesale allocations were being rationed on a priority basis. Settlement alerts circulated that COMEX was offering cash settlement options to contract holders seeking delivery, with exchange officials citing extraordinary market conditions as justification for deviating from normal settlement procedures. The system had openly acknowledged it couldn't deliver physical metal to all claimants at contracted prices. That acknowledgement, buried in technical language and settlement notices, was proof the fractional reserve system had reached its limit. This wasn't the beginning of normalization. It was confirmation that the squeeze was intensifying. When spreads hold at historic extremes through an entire trading session, when dealer inventory stays depleted despite every incentive to replenish, when exchanges start offering cash settlement to avoid physical delivery obligations, it signals that supply constraints are real, structural, and unlikely to resolve quickly. The market was repricing silver from a paper-traded commodity to a scarce physical asset with supply that couldn't meet demand. The spread that opened the day at $3.50 closed at $6.15. The arbitrage mechanism that should have narrowed that gap within minutes never appeared, because the metal to execute arbitrage didn't exist in sufficient deliverable form. Inventory depletion, persistent premiums, backwardation, rising lease rates, and widening spreads. Every data point confirmed the same crisis. We are witnessing the beginning of a new precious metals rush, except it's silver, and the rush is driven not by discovery but by scarcity. The squeeze isn't over, it's just beginning. Keep your eyes on these numbers. If the spread opens Monday above 8 Azores, the endgame has arrived.